Hello, everyone, and welcome to this special of our Delta Neutral TradeFinder Live. We're very excited to be here with you all, and we're just going to wait another second or so to allow everyone time to join. In the meantime, this is our live disclosure disclaimer agreement. If you've attended any of our live sessions, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We do have this available on our website if you'd like to read it in full detail there, or certainly feel free to take a screenshot of it if you like, but that's the main point to take away. All right, so for this session, as you'll see circled on the screen, we are just going to have questions come in through the Q&A method. We are live streaming to multiple platforms, just as we always do with TradeFinder. So with the time remaining after Rob and Jeff go through their presentation, we will open it up to a combination of questions with the time that we have left. So for our Zoom audience out there, any support related queries I can handle in the chat. And of course, for any interaction amongst other attendees, please feel encouraged to use that window. Just note that by default, it goes to hosts and panelists. So if you would like everyone on the webinar to see your message, be sure to change that to at the bottom to everyone. We're not going to do any voice questions tonight. So at any point throughout the session, please feel encouraged to write your question into the Q&A window. All right. I will stop rambling on and move out of the way for the 2 minutes of the hour that we're here for. And at this moment in time, I'll introduce Rob Roy.
Hi, everyone, and welcome to this special presentation for our TradeFinder subscribers on Delta Neutral Trading. What we're here to talk about tonight is the launch of our Delta Neutral Trader service. And introduce you to Jeff Beamer, and we're excited to have him at the LA Wave Options team. We've talked about this before, but when we talked about expanding, I said I've got the guy that we need to have for our expansion, but I don't know if we can get him. So the fact that Jeff has agreed to become part of the team is really exciting for all of us. A lot of you, our subscribers, have been asking about iron condors. I get that question quite often, whether it's a TradeFinder or our insiders meeting, and just going to talk to you about those tonight. He'll also go through a review of the performance of his strategy, and then the most important part is we'll tell you how you can access this new strategy for the Delta Neutral Trader portfolio. So with that said, let's go ahead and jump in and get started. Just a little bit of background here, and then I'm going to introduce Jeff. So since introducing the level 1 LA Wave option time strategy in 2021, it's become a favorite of our subscribers. In fact, I get support messages all the time, emails coming in through the support portal saying that, wow, this time strategy is becoming my most favorite strategy. And we have the impulse strategy, we have the volatility strategy, and then we have the AI-based time strategy. And people really like it. The idea of the Delta Neutral setup has been very appealing to our subscribers. And you guys have said you like the style and want more. There's a limited number of opportunities with the time strategy that we have. And it's been en masse, if you will, people wanting more of those type of trades. Well, we're going to be able to provide that for our subscribers now. So with that, I'm very pleased to introduce this new service, and also a good friend of mine, and very excited to have someone of his trading pedigree. I imagine most of you have heard his story, but hopefully he'll give you just a minute or two of his background for those of you that may be streaming with us tonight and haven't met Jeff before. But with that, I'm going to introduce Jeff Beamer. You there, Jeff?
I am here. Good evening. Good evening. Good evening. How is everybody? Rob, I'm excited to be here tonight.
Well, we're excited to have you. Thanks for doing this. And I'm sure everyone watching is going to be really excited by the time you get through this presentation, because it's some really good stuff.
Well, I'm going to start off tonight by just kind of talking a little bit about the service and about where this fits in. So I'm going to share my screen here, and we're going to pick up right where Rob left off. Let me first introduce you to me, and I want to introduce myself and a little bit about my background. I've been doing this in this industry since the early 80s, actually. not to go back to, too far, but I had 3 security licenses before I turned 20 years old. Okay, I was 19 when I got into the business, and jumped right in. Knew this is what I wanted to do for a career. Had some great years up until 1987. Had a little, well, let's just say a big bump in the road, and learned some incredible lessons that I've really have stuck with me till today. But that one event sent me down a path where I eventually became started managing money for other people, formed an onshore offshore hedge fund. I ended up creating a couple of different hedge funds and a couple of different investment firms, including 40 Act mutual funds. I've been so heavily invested on the side of the business that involves trading and security specifically. As you can see here on my bullet points, I've served on industry committees such as the Security Traders Association. I was president of the local chapter here in Dallas. I'm the former chairman of the Market Technicians Association here in Dallas, which, by the way, is the certifying body for a designation called the CMT. That's the Chartered Market Technician designation. That's very similar to somebody getting their CPA or their CFP. Okay, CMT has become more recognized over the years, really for the past, really starting 20 years ago, but especially about 15 years ago, it started gaining some real notoriety just because of the performance of market technicians in the industry and their contribution to the securities business. So I come with a lot of experience, and over the years, one of my favorite types of strategies, and one that really took over a predominant part of my trading, was learning how to trade what's called a delta neutral style of trading. Okay, it was something that delta neutral trading is something that's unique in the securities industry. It's not something that you can typically do if you're buying like residential or commercial real estate. You can't be delta neutral there. If you're buying art, you can't be delta neutral there. If you're buying fine watches, you can't be delta neutral there. So it's something that's very unique, and the concept of making money from specifically something that so delta neutral can encompass either directional or non-directional trading. It was that non-directional type of trading that really caught my eye, and I can actually make money from a stock that goes nowhere. And then through years of research, realizing that stocks actually trend in a channel or trend sideways 70% of their a life cycle, I was like, oh my gosh, the opportunities here are just incredible. So let me talk about how this service is that we're going to bring to you. It differs from what Rob and company have done up to this time. With directional trading, what often happens when you take either let's say you're bullish on a stock and you're expecting it to go up. Oftentimes you get into a trade and there's, it might kind of go against you for a while before it eventually gets up into the profit zone. And with certain strategies within the delta neutral arena, this doesn't have to happen. These drawdowns that you see where the stock and kind of moves against you doesn't always have to happen. Specifically this red area here. What thing delta neutral strategies do, like calendars, which the calendar AI product brings to you, is the ability for your position not to go through that cycle. Okay, so instead of having that big drawdown, with the current AI calendar system, when you find the opportunity, really you're in the green from day one, typically. Okay, with delta neutral strategies such as calendars or iron condors or condors or at the money butterflies. This is the type of risk graph that you can experience when you have those types of opportunities. So what is the EWO delta neutral trader opportunity? Well, essentially with this service, what we're going to do is target stocks that are range bound or in a slight upward or downward channel. Okay, so either sideways or within a mild directional bias. All right. The opportunities that get presented just in stocks that trade that way are the number of opportunities can be amazing at times. I mean, just when all of a sudden stocks just stop and they, for example, Apple, of all things, Apple back in the early 2000s. Okay, I traded Apple between $12 and $15 for 2 years. For 2 years, and made a ton of money on Apple while it traded between $12 and $15. Okay, and then it took off. All right, there are tons of stocks that do that. All right, and this is where we find incredible returns over time. Now we also want to profit from 2 features of options that occur on a regular basis, and one of those is time decay and implied volatility. Okay, now time decay, options lose their value over time. Okay, they have a defined date when options expire. Okay, when you learn to put the time decay on your side, you essentially increase your odds of success. There's nothing worse than, for example, being a directional trader and one of the first things you learn is to buy a call option. And you buy a call option on your stock and the stock goes up, but you lose money on the trade. And understanding these 2 things here, time decay and implied volatility, is the reason that that type of trade works against you at times unless you know how to handle these 2 Greeks. Okay, theta decay and vega. Okay, theta decay is time decay, vega relates to implied volatility. All right, now the strategies that we're going to deploy range the gamut. Okay, we're going to do a different style of calendar spread. Okay, so you have your AI, which is impressive. I mean, I was very impressed with everything that went into the AI and finding calendars there. All right, but I also have a methodology for finding calendars and trading calendars that has served me well for over 30 years. Okay, diagonal spreads. Okay, diagonals, double diagonals, butterflies, iron butterflies, condors, iron condors. We run the gamut of opportunity with delta neutral strategies. And like I said, some of them are directional a little bit and some are non-directional. All right. And the non-directional is one thing that sets apart a delta neutral trader from really anything else. The ability to make money when that stock goes sideways there's nothing more gratifying. Okay, so let's take a look at iron condors for a minute. Now, over the years, people and those that want to create a name for themselves have kind of poo-pooed on the strategy and, oh, you don't want to do an iron condor, you want to turn it into something different, and they come up with all these different names. And the bottom line is there's nothing new in options trading. Okay, every strategy has been thought of by the 80s, if not the 90s. Okay, no matter what type of wings you have or how many contracts or ratios you have, they've all been it's not like an unlimited number of strategies you can do. Okay, they've all been thought of. But the great thing about iron condors and why people have loved these for so long is, number one, they're what we call balanced, meaning there's an equal number of contracts along all the strikes. And the stock or underlying security doesn't have to go anywhere. It can just sit there and we make money through time decay and possibly a change in implied volatility. So let's take a look. Let's cover the basics of an iron condor for just a moment. You know, that is, as Rob mentioned, was something that, you know, people were asking more of. Hey, can we do more of these, or can we see more of these? And that's something that we're going to bring to the table. So effectively, it's a strategy by combining two vertical spreads, okay? A bull put spread and a bear call spread, okay? These are two credit spreads. When combined together, make a iron condor, okay? These two credit spreads create a larger credit than one. And the goal here is to generate income through the premiums received while minimizing the risk through the legs, through the purchased options, which are further out in strikes, okay? So essentially we're selling a call and a put and then buying a call and a put that's in wider strikes. That's one way to look at it. Or by the first bullet point here, a bull put credit spread and a bear call credit spread. Or if you're in the industry and you hate those terms, we're going to sell a put spread and we're going to sell a call spread. Okay, that's the lingo here. Now, this strategy makes money if the underlying asset remains within a certain price range until expiration, and it will incur a loss if the asset moves outside of the range, or what's known as the break evens. All right, so let's take a look at what we call a risk graph. Okay, and one nice thing about how we trade is we use modeling to help us visualize our risk in the position. Okay, so some people like myself are very visual, and I like to see where my opportunity exists and where my risk lies, and that risk is very important to me. Okay, so when you have when you buy a long put, okay, you make money as the stock goes down. So if you buy a 40 strike on a stock that's, say, trading at 45, okay, you're looking for that stock to go down. You buy this 40 strike put. You make money when that stock drops below 40. However, if you buy when you sell, that's buying the long put, okay? When you sell a short put, say at 45, where the stock is trading in this example, that creates an entirely different type of position. When you buy the lower, sell the higher, that becomes a bull put spread, okay? You receive a credit, okay? And you experience risk in the position, okay? In this case, we have a $5 Y spread. We bought the 40s, sold the 45s. My maximum risk in the position is $5 minus the credit that I received, okay? So in this case, the risk is $3. The max profit is $2, okay? Now, the same thing goes on the call side, okay? When you sell a call, you're also bearish, okay? But when you buy a call, you're bullish. These kind of offset themselves depending on where you place the buy strike and the sell strike. So when you buy the higher strike and sell the lower strike, as we've done here, we bought the 55s, sold the 50s, that is a bearish trade. The reverse of that is if you bought the 50s and sold the 55s, that's your bullish trade, okay? But this setup right here is your bearish trade, okay? Same thing, same scenario here. If you did a $5 wide spread and you sold that spread to open, okay, because somebody bought it, okay, you're selling it to them, okay, your risk is the width of the spread, that's $5 minus the credit you receive, okay, then that leaves your risk. So your risk is $3, your max profit is $2. Now, what happens when you combine all of this together? Okay, you have your bull put spread and then you add your bear call spread, well, all of a sudden you've created your iron condor. Okay, you add those two credits together, but something very interesting happens here. Remember, I said your bull put spread had a max risk of $5, the width of the spread here, $5, 40 to 45. Okay, that risk is $5. Okay, but then you also have the bear call spread, the 50-55. Okay, that's $5. Okay, so why in this case, what is our risk here? Is it 5 or 10? Well, as you can see from our math up here, it says max risk is only $1. All right, how is this possible? Well, remember the bear call spread, we took in $2, okay? And the bull put spread, we took in $2, okay? You add those two together and you get $4. But the markets are smart. They know that the stock can't be in two places at the same time. So instead of having $10 of risk, okay, no, you only have $5 of risk. That is one of the unique features of an iron condor, okay? You only have, or any type of credit spread where you combine calls and puts together, market makers and the OCC, the Options Clearing Corporation, they know a stock can't be in two places at the same time. So they're not going to charge you double the margin. They're going to charge you for one side. One of the great benefits of doing a trade like this. And this is why, you know, people have been asking for this type of trade. Okay, so the ideal setup for an iron condor obviously is, first of all, when you look at how much time, usually between 25 or 20 and 50 days, you know, somewhere in there, we're going to be setting up an iron condor. You can go longer, okay, but a couple of dynamics happen when you go longer. We're looking for implied volatility, ideally to be medium to high, okay, and that information is usually a little harder to find, but through techniques and software that we have, it's really easy and we find it right away. Okay, we want statistical volatility ideally to be relatively low. Now, statistical volatility, what is that? Well, statistical volatility is actually what the stock price is actually doing. Okay, it's the actual movement of the stock. Okay, so if a stock is for example, going way up and way down and way up and way down and way up, that has a higher IV than a stock that is, say, trading in a little bit of a range, okay, like this, okay, that's going to have a lower SV, okay? This is high SV, okay? This is low SV. Thought I could write better than that, but oh well. Okay, so statistical volatility, we want that to be low, and implied volatility, what the market thinks about what's going to happen with the stock or what's going to happen with that sector, that's going to be medium to high. Okay, the net delta, we usually try to get that as close to possible to zero. And again, this is with iron condors or at the money butterflies, okay? As close to zero as possible to make that delta neutral. Gamma is less important at the setup for those of you that know a little bit more about options and what gamma's impact on delta is. It's less important at the setup, but more important later in the trade. And that's really where we come in and managing the service and managing these trades and watching them as we put out alerts. All right, so let's look at a couple of trade examples here. Just two quick examples. Earlier this year, actually late last year, we put on a trade on XBI. Okay, this is the biotech ETF. Okay, it was trading in a nice sideways pattern. and we put on this iron condor. Okay, so if you look closely here, in fact, let me go back. You can probably see it easier here. All right, here's your bear call spread right here. We bought the 92s, we sold the 88s, okay, on XBI. And then on the put side, here's your bull put spread. We bought the 67s, sold the 72s. All right. So in this particular case, well, there was actually an error made. Look at this. 88 to 92 is only $4, as somebody wisely pointed out to me. Okay. And yet this side is $5 wide. What happens here? Well, not to confuse things, but really this trade was supposed to be 5 and 5. It was supposed to be equidistance, but through really a little bit of a gap, it became 4 on one side and 5 on the other. Is that okay? Well, yeah, that's okay. It has different setup, but the setup was the same. Okay, the risk graph that we call is the same. All right, and you can see in the graph in the upper right hand corner here, this graph, notice that except for one little hiccup, notice that right out of the gate we were in profit. Okay, got towards the end, we had a little dip. I'll show you what that dip was, because it really wasn't. It really didn't go. Although it went negative, I'll show you how we weren't really concerned about it. Okay, and then boom, nice profit at the end. Okay, so how did this trade turn out? Well, this particular trade, did very nicely. The trade set up at the beginning looked just like this. Notice that XBI is just trading in a range, okay? Just going sideways, okay? Trading in a nice little range. And we set up a trade where we have one break even up here, okay, at about $89, and another break even here at about $71, okay? As long as it stays between those break evens, then we're going to be in good shape with this particular trade, okay? So what happened over time? Well, what we have here, let's see here, bring that up here. This is what happened in the trade, okay? Now, that little blip down below 0, that happened right here, okay? But notice that it never closed above our break even. It went right up, it challenged it, but then it dropped back down, and at expiration, this blue line is showing at expiration where we are, and we are right in that profit zone, okay? $102 was the credit on this trade, okay, per spread, $102, all right? And that was where this trade ended up. Now, you think, okay, $102, big deal, okay? But let's say we used a hypothetical $10,000 account, okay? That $102 is actually a 1% return on risk over how many days? Let's go back and look here. 32 days, 1 month, a 1% return on portfolio, not on risk. Okay, risk, it was even better return on risk, but on portfolio, 1% return. Big deal. Well, guess what? Right now, this service has another trade on XBI right now, okay? Another trade. We went back to the well and doing another trade. Oh, and if it stays in the range a little longer, can you do another one? Yes. And all of a sudden, oh, what about another stock and another stock and another stock? And you get, oh, all of a sudden you're getting 3, 4, 5% return in a month just on stocks that aren't going anywhere. This doesn't even touch the calendars that we're doing, or the directional butterflies, which have incredible ROI numbers, okay, or condors, which have very impressive ROI numbers, okay? That trying to remember the let's see here. I'm trying to remember one trade that we have on right now that has a 400. We have a, on one of our services, we have a call condor right now on LMT that has a 400% risk to return opportunity. And the trade is already up about 100 and something percent on risk. And it's not even in the body of the trade yet. I mean, it's just beautiful, beautiful, beautiful trade. Okay. This is an example of a well-executed condor, or excuse me, iron condor here. I was talking about a condor, which we'll talk about later. You'll get educated on that if you're not sure what the difference between the two is. It's very just good basic stuff. Even though they're complex trades, they're easy to understand when you work with us. Okay, so this iron condor. So what about a different one? Okay, so here on Apache, we kind of solved the same thing. Okay, we saw a stock that was trading in a range, and what was it going to do? So we did was we initiated an iron condor on this, and you'll notice here that we have the bear call spread up here, and notice, yes, it's $5 wide, and then the bull put spread down here, and yes, it's $5 wide. Okay, now this trade expires actually February 17th, next week. Okay, but how is this trade doing since it since we put it on? Well, you can see in the upper right hand corner the risk curve here. Literally out of the gate after fill, we started getting that theta decay kicking in, and stock just trading sideways, and up and up and up we go. Okay, along that curve. Well, let's take a look and see. This was actually last week. Okay, this was the beginning of the trade. Sorry, on January 18th. Okay, on this particular trade, we had 30 days to expiration on this particular example. This was the setup. Okay, then we advance forward to last week. Okay, notice the risk graph in the upper right hand corner. Okay, now we're into the trade. It's making money. It's profitable. This was actually last week. Let me take a quick look over here, and let's see where Apache is trading today. Oh, what do you know? It's trading at $42, right? Okay, it's trading at closed at $42. It's right here. Okay, so these lines are going to be pushed in. We're right about here on this trade. Okay, right now we've got a really nice profit on the trade. Not quite ready to take it off yet, but the stock, look at it, it's sitting right at support. Look at that, 42 is support. See that right there? That's where it closed today, right at, well, 42.12 is where it closed. Okay, so we're just cooking on that. All right, so guess what? More profits coming in. Okay, on that strategy. So looking at some track record performance, each year I do a class, and really it starts off as it's called calendar mastery. Okay, but by the end of the class, we start getting into other delta neutral trades, specifically diagonals, butterflies, condors, and iron condors. Those are kind of the basics of the strategies that we do around there. And so last year, I did the class twice, and of all the trades that we took live in class, okay, what I did was base the strategies on starting with $10,000. Okay, these trades were shared. We did them live in a class with the students last year. It netted just those trades. We had a winning percentage, you can see here, of 83%. So last year was really, solid year. So we had 35 winners between the two classes. We had 35 winners, 7 losers. Okay, largest gain was over $800. Largest loss was only $95. Okay. All right. And then the total profit was $4,756. Now realize that's 42 trades for the year. So that would be less. That would be one trade a week, less than one trade a week. All right. Less than one trade a week. That's a 47% return on portfolio. Just doing in this mix were calendars, a couple of diagonal spreads, several iron condors, a couple of butterflies, okay, in those classes. Okay, that is the type of return that we seek to do each year. Some years are better than others. Okay, in fact, I think I just had I have one loss right now that's down. It's right down at $100. Okay, so a little bit larger than this 95 right here. Okay, but gains, you know, like I said, we have a trade going on right now that can almost a 400% potential return. The max gain in that trade, believe it or not, is for one contract is $1,600. Okay, for just one contract. All right, pretty solid trade right there. All right, so this is really designed to be a non-directional income strategy for stocks that we expect to trade sideways in a range. We want them range bound, trading in a channel that can be either sideways or within a mild directional bias, meaning, you know, we can have a stock going up that's in a channel going up or a channel going down, but, you know, we want it to be quiet SV, just in a normal, you know, kind of trading range. We're going to take advantage of time decay and implied volatility. And again, the strategies range all over the gamut. Okay. And again, one strategy that you're not seeing here are straddles and strangles. Okay. And the reason why is because I like being on, let's just say I like being in the house. Okay. I like selling premium and all of a sudden putting theta, okay, time decay on my side. That gives me the edge. That's exactly what the casinos do in Vegas. They look for that little bit of edge, okay, and then they let the gamblers play, okay. Here, I'm looking for that little bit of an advantage and then letting the traders trade, okay. That's what I'm looking for. All right, so with that, let's bring Rob back in, and hopefully Rob didn't fall asleep on me. I mean, you know.
No, I enjoy watching that each and every time. So I'm excited to show everybody how they can access it. Hopefully everybody can see my screen. That I've gotten the screen back now. And so I'll go through and tell everybody exactly how you can access Delta Neutral Trader. So for those of you that are not familiar with our trading service, just to give you an idea of how things work, we go through on a daily basis. Jeff does this as well. We run scans, we look for candidates, identify potential candidates, and if we find one that we like, we send those out as an entry alert to our subscribers via SMS and email, or both if you prefer. Most people like both. In this day and age, everything comes on your phone pretty much anyway, whether it's SMS or email. So we send those out, whatever your preference is. And we also want you to learn. We're really focused on education. We're not just primarily an alert service. We want you to understand and learn these strategies and incorporate them into your own trading. There's only about 5% of option traders, which is, options is a small market anyway. It's only about 5% of option traders that really have a good, strong working knowledge of how options work, the intricacies of options. We want you to be in that upper echelon. So we're going to educate you on everything that we're doing. So when a new trade comes in, we'll educate you. We do that based on commentary on the alert that comes out, or we will go through and do periodic presentations on maybe a different strategy. Right now, you learned iron condors tonight. And as Jeff said, there's other strategies that can be used in the Delta Neutral Trader as well. We review all of our positions every single day, an analysis, and you'll get those alerts for entries, any adjustments during the course of the trade, and exits. And you have access directly to us, in this case, Jeff, on his Delta Neutral Trader. If you have questions to ask him, you can send them directly to him. So we are accessible, again, wanting you to learn throughout this process. So how much is it? Well, for a monthly subscription, it's $189. Now, we don't bill in advance, right? There's no yearly commitment. There's no contracts to sign. Nothing. It's a month by month. So you give us a try for a month, kick the tires, see what you think, and that's it. You don't like it, no harm, no foul. You can cancel, and we make your cancellation process very easy. It's not one of those things where you have to call people and wait forever to get it done. So what's included in the monthly subscription is those trade alerts via SMS or email. It's a fantastic value if that's all you got, but there's a lot more that comes with it. There's chart analytics and the plan for each trade that comes out, part of that educational process. So you can learn, why did Jeff select this one? What is he looking for? What are the criteria for entry? And then you also have access as a subscriber to our premium education courses. Those are the webinars that I was just mentioning that we do periodically. You have access to all of those included in your subscription. And we have an insiders meeting every Thursday night. You're used to the TradeFinder meeting where we do a real short Q&A at the end, and the insiders meeting for our alert subscribers only on Thursday nights. We do a extended Q&A, 45 minutes, and normally we get through all the questions throughout. So if you have a question, that's a perfect opportunity to speak to Jeff about what's going on. So he will be joining us on those insiders meetings. So both of us, a lot of experience. I've had over 25 years here. Jeff's over 35 years. So 60 years of trading option experience that you can have access to. What's the value of that? I don't know that there is a value for that with the things that we've been through and that we've seen. I didn't go through 1987 like Jeff did, but I imagine that he learned an awful lot going through that. But as a short-term offer here, we are going to give you a discounted price. So for $129, which if you saw the performance record, that's less than the average profit in his track record. So for less than the cost of one trade per month, you can give us a try for a month. This offer is going to end February 21st, and the price will go back up to $189. So you can get it for $129, again, less than one trade per month, but you have to sign up by February 21st. In fact, if you sign up tonight, this is live. The service is working right now. You may get a trade as early as tomorrow if you sign up tonight. So you could jump right in and experience this firsthand. So how do you sign up? Well, you can go to ewotrader.com/TradeFinder-DNT. That's for Delta Neutral Trader. So part of that's getting cut off at the bottom there, but it's TradeFinder-DNT. Also, as a bonus, we're going to include something called Tom's Tools. We are partners. Some of you may have been familiar with Optionetics in the past as an educational company. Tom Gentile is a well-respected options trader. He was my mentor way back when I first started, and he has some trading tools. They run searches for you, identify different opportunities, and that's going to be included. You're going to get a 3-month subscription to that for free. So just included in this $129. Again, if you sign up by February 21st, that will be included. You can see if you like it, find other trading opportunities, go through and create your own searches, look at risk graphs, etc. Tremendous amount of information and value for this options trading tool, one of the best options trading tools that exists on the market, if not the best. So you'll get a chance to see if you like it for 3 full months. We're going to include that for free. But again, ewotrader.com/TradeFinder-DNT. I don't think you want to wait till the 21st because, as we said, Jeff's sending out trades. We were chatting beforehand. He said there may be trade. I'm not putting you on the spot or anything. There may be a trade come out tomorrow, but if not, it will be soon because it is.
Let me jump in there real quick and talk about Tom's Tools real quick. One added bonus that we're gonna do. The tools are very powerful and have a lot to them. In fact, this offer of 3 months free, this is kind of unheard of. If you went to that website, and want to do a trial, it's $14 for 14 days. Okay, that's on the site. If you were to sign up, we're going to give you 3 months for free. And with that, we're going to give you access to something called Study Hall. Okay, and it's the original developer of this tool, along with another expert option trader, going through the basics of how to create folders, how to save trades, how to do the modeling, etc. That will be included as well. Study Hall is an incredible value to be tossed in there with that. So, Rob, I just wanted to throw that little nugget out there for everybody that's going to pop in with us.
Oh, that's awesome, Jeff. Appreciate that, because I think the average person, if they pulled up the Tom's Tools, they would be a bit overwhelmed with the sheer amount of information that's available there. So it would probably take 3 months just to try to get through it and figure out what's there, and then the subscription's over. So you're going to show them how to use it, or give them access to show them how to use it and what everything is on there. That is a fantastic value. That speeds up your learning curve significantly. So there you go. There's another great value included if you sign up before February 21st. And by the way, one other thing, you are grandfathered in. So if you sign up prior to February 21st, you get the $129 as long as you remain a subscriber. So it isn't just a 1 month thing and then kicks up. So you want to take advantage of that offer. Again, less than the average gain per alert that's been sent out. So ewotrader.com/TradeFinder-DNT. Go there and sign up now. Go right to the page and sign up from the page. Jeff, do you have a minute for some questions?
Absolutely. Yeah. Saw a few coming in, so let's knock them out.
All right. Zach, I'll bring you back up, and in the meantime, I'm actually going to go to the page, and I'll come back and show people exactly, walk them through how to go through the process of signing up. So if you want to give them a few questions right now, and then I'll come back in just a moment.
Awesome. Sounds great. Yeah, thank you for an excellent presentation there, Jeff. And we will hop in. We got a good amount of questions here from our live viewers out there. We'll start out with a two-part question here from SR from Zoom. What criteria do you use to select the width of the iron condor?
Well, that varies upon the statistical volatility of the stock, and we'll see what kind of fits the risk parameters that we set. Typically, we don't risk more than 5% of portfolio in any one position. So we do kind of keep that in consideration. So the strike widths, will vary from time to time, depending on what the stock price is. Stocks that are less expensive, say under $50, that have $1 strikes, or for that matter, even stocks that are more expensive that have $1 strikes, we can adjust that accordingly to fit our risk parameters, and it will vary. So there's lots that go into that kind of question, but that's kind of some of the basics right there. I hopefully I answered that for him.
Hey, Zach, before you get to the next question, I just want to let everybody know I have brought the page up. This is what it looks like when you go there, ewotrader.com/TradeFinder-DNT. And so you can see here's the offer, and you got the countdown clock there until that offer goes back to 189. All you have to do is put in your email address, your credit card number. You need to click that button saying that you understand that you will be charged on your credit card, but just for 1 month at a time. Again, no contracts, no advanced year in advance, none of that. Just try it for a month, see what you think. What do you got to lose, really, for 1 month? Make sure you say you're not a robot, because the world we live in now with all the bots that are out there, it's incredible. And then hit submit, and you're done. And if you go to the page, you can see all this information that we've covered tonight. I know it's a lot in a short period of time, but you can go through and see everything that's included in your subscription. And then there's a number at the bottom there. So if you have any questions on signing up, again, I've just showed you the page, but you can go to this number here, or email at accountservices@ewotrader.com. But this is a support phone number. You can talk to Steven. We'll answer the phone and he can answer any questions that you may have regarding the service, getting signed up, etc. So make sure you make note of that phone number here at the bottom, or account services at ewotrader.com. All right, so Zach, I just wanted to share everybody that so they could be looking through it while we get to some more questions.
Awesome. Yeah, no, that's certainly helpful. And in addition to that, I dropped Steven's information into the chat for all the live platforms out there and for our Zoom audience.
Great.
As mentioned, he's definitely more than happy to assist with any type of
Yeah, he's aware of the discounted price too, so you won't have to say, hey, well, they showed us you're trying to charge me $189 and they showed $129. He's aware of this discount until the 21st.
Very well. Thanks, Rob. All right. So, Jeff, another question here for you from SR. In addition to historical volatility, do you also consider the ATR?
Well, the average true range gets into that statistical volatility category. So, I mean, there's a lot that goes into our lists, and great care is taken with those lists.
In other words, Jeff is going to teach you the strategies and the education of the strategies, but he's not giving the farm away. You're not going to get the proprietary information. So that's why there's a subscription. So you get the knowledge, but not the sauce.
Yeah, yeah.
I'm sorry, I didn't mean to interrupt, Zach.
No worries, no worries. Just making sure I can get through as many questions here with the time remaining. Question here from TJ. How can this work with a full-time job, limited, sometimes no access to the markets during the day? So just to quickly add to that, I know we're not affiliated with any auto execution services, but there's certainly information I'm happy to provide if that's something you're interested in regards to brokers that we're aware of that do provide those services. But again, we have no association and can't make any recommendations there. So I'll pass it over to you, Jeff, if there's anything you wanted to add.
Well, yeah, so the beginning of the question was they have a full-time job, right? Is that correct?
Correct.
Okay, yeah, this is perfect. This is ideal. Really how I run the methodology is based upon when that I've done since the 90s when I started writing publications were based upon people who had other interests that weren't sitting in front of their computers all the time. So I typically will use a good till cancel order that will last maybe 2 to 3 days, okay, and give people an opportunity to get into a trade at a certain price or around that certain price. Okay. And what ends up happening is if you may miss a trade on one day, but then all of a sudden you get home and you see the alert and you take action the next day. Well, there'll be times when the price is better the next day. There will be times when price is away from you and you can't get in. It all averages out in the end. Okay. As long as you're consistent, it'll all average out. And so, yeah, you don't have to be sitting in front of your computer right when you get the alert. Hey, it's a working order. It'll be there for the day, probably 2 to 3 days for you to have that opportunity to get in. So, yeah, it's ideal for that situation.
Very well. All right.
That's awesome. So it's not one of those things where if you don't get filled in 20 minutes, you're in trouble. Right.
Right.
No, that's a nice feature, especially for people that do have other things going on in their lives and they don't sit in front of the computer 24/7.
Right.
Like we do.
Right. Yeah, right. Right.
And while we were talking about old trouble there, just a question here from Angry Sushi on YouTube. Trading with a small account, should I be concerned of getting assigned?
No, assignment is part of trading options. We all have gone through it. Exercise and assignment is something that happens, and with a smaller account, your broker is just going to step up and say, hey, you need to exit this within the settlement period, okay, and close out that trade. All right, that's really all there is to it. Now, in fact, exercise an assignment, as an institutional trader, I would actually use assignment as a way to exit some of my trades, because it was a fixed price. And if I was trading a bunch of contracts, it was actually cheaper to go through assignment than to actually try to physically exit all my contracts. So yeah, you don't need to worry about assignment. Occasionally it'll happen. We'll talk about it and talk about how to handle it, but your broker will also help you handle it as well. It's not a problem.
Yeah, just for an example, if I could hop in there, when you're assigned stock, it's like buying the stock, right? So you're assigned the stock that settles 3 days later, and then when you sell the stock, it settles that night. So settlement when you sell the shares is that night. So there's a little bit of a 3-day window. As long as you sell the shares within 3 days, you actually don't physically have to pay for them. So it's not a concern, as Jeff said. So, and in fact, I think Jeff would agree. Sometimes assignment is a great thing, because the premium that you're trying to collect, they just gave to you.
They just gave it to you. Yeah.
And you might wonder, well, why would anybody do that? Well, there are a lot of people trading options that don't really fully understand intricacies of what they're doing and how extrinsic value works, etc. And sometimes you're like, thank you, that was great, and I don't have to wait 2 weeks to get the profit. You just gave it to me in 3 days.
Yep.
I guess this kind of furthers that in a sense from futurists here. Question is, do you roll one of the verticals further out if price moves too close to that side?
If the opportunity kind of presents itself, there's something that involves time and price. And if there's time, or depending on where price is, and that opportunity is there, then yeah, it's something that we may consider doing. But it's a case-by-case basis. It's not, there's no standard rule to that.
Awesome. Thanks, Jeff. So next up here, we have Brian. Normally low SV goes with low IV. What causes the disconnect?
That's where having tools comes into play, because while traditionally low SV generates low IV, that's not always the case. And even with lower implied volatility, sometimes we get the premium we need to make a great trade. So yeah, it's that's something that we look for. And there's actually something, for example, in calendars that I look for called skew in the implied volatility. More on that later. There may be a class coming up in your future, but we teach about that and we look for it, and I'll show you how to look for it. But yeah, there's certain things in the market that give us an edge, and we look for those opportunities. So yeah, it's not always the case where SV and IV are always low together.
Yeah, it's not an exact science, and as Jeff said, there's actually in those tools ways that you can search to find those opportunities where there's some mispricing, and it's an extra feather in your cap, or extra couple percentages of potential accuracy in your favor when you find those opportunities.
Right.
Absolutely. Yeah, thanks for that explanation there, gentlemen. And just a question here from Reishi is, do we keep stop losses for each trade we enter? Which we certainly we don't. I don't know if you wanted to add anything to that, but I think that one was
that, everybody's risk tolerance is different. Okay. And for those of you that have seen me before, this, I'm not a fan of stops. They have ruined more trades for me than they've done good. And sometimes the stock can hop over your stop and you're still in the trade.
Right.
Oh, I have a stop at 50, and all of a sudden stock gaps down to 43, and you're like, why am I still in this trade? Well, it hopped over 50 and went to 43 and you're still in. Okay. It's like, oh crap. So how I manage that is through size of positions. Trade small, trade often. You probably heard that term before. That's how you kind of manage it. I think people overtrade in size, and that's an issue. We like to trade small and just increase number of occurrences. Okay, and that's what gives us the big profits that we tend to see, or good returns on an annual basis. Yeah.
I feel exactly the same way. I'm not a fan of actual stops either, because the market makers can see them, and if they have the opportunity to stop you out, they're going to. I'm sure people have seen instances where they had a stop in place, they got stopped out, and then the stock turned and went right back to the same direction that they expected it in the first place, and they're not in the trade because they got physically stopped out. Well, we're at the top of the hour, Jeff, so I wanted to thank you so much for your presentation. Those of you that may still have questions, sign up tonight, and you can join us tomorrow night in our insiders meeting, where we'll have an extended Q&A, and then you'll have the opportunity to find out more. And Jeff's going to be there, and he's going to be talking about a couple of the current alerts that are on already. So you're going to be learning about actual positions right off the bat. So hopefully you guys will all sign up and join us. Again, can't beat the price. Less than the profit of one average trade from the track record. So sign up now. If you have any questions, use the phone number or the email address. Thank you so much for your time, as always. And hopefully we'll be joining you guys together again tomorrow night at the Insiders meeting. So thanks, everybody. Take care. Look forward to talking to you.